Have you ever wondered what happens tax-wise when you sell an investment that has grown in value, especially something like an exchange-traded fund? Yes, you generally do pay capital gains taxes on exchange-traded funds, or ETFs, when you sell your shares for a profit. This is a fundamental aspect of investing that can impact your overall returns. The reason for this is quite straightforward. When you purchase shares of an ETF, you are buying a piece of that fund. If the value of those shares increases and you then sell them for more than you paid, that increase is considered a capital gain. This gain becomes taxable. The specific tax rate you pay depends on how long you held the ETF. If you held it for 1 year or less, it is typically taxed as a short-term capital gain at your ordinary income tax rate. If you held it for more than 1 year, it is usually taxed as a long-term capital gain, which often has a more favorable, lower tax rate. Understanding this means you should always keep good records of your purchase dates and prices, as well as your sale dates and prices. This helps you correctly calculate your gains or losses. Also, consider using tax-advantaged retirement accounts, such as a traditional individual retirement account or a Roth individual retirement account, to hold your ETFs. In these accounts, capital gains taxes can be deferred until retirement withdrawals or even eliminated entirely, as with a Roth. A key concept here is your cost basis, which is essentially what you paid for your ETF shares, including any commissions. When you sell, your capital gain is the difference between your selling price and your cost basis. ETFs have a unique structure involving what is called the creation and redemption mechanism. This often makes them more tax efficient than traditional mutual funds when it comes to internal capital gains distributions. However, when you, the individual investor, sell your ETF shares on the open market, those personal capital gains are still subject to taxation. By keeping track of your ETF transactions, understanding the difference between short-term and long-term gains, and utilizing tax-advantaged accounts when appropriate, you can manage your tax obligations effectively. This strategic approach helps you retain more of your investment growth, contributing to a more secure and confident financial future in your golden years.